What's up, family? I'll be teaching you about the break of structure and liquidity grabs. A lot of people are very much confused about the two, how to see them, how to spot them, how to mark them. And of course, I'll be teaching you in context with the trend that you'll be trading into, a bearish and a bullish market. And of course, I'll be helping you to make it easier for you to spot them in your day-to-day as you're trading. And of course, this is smart money concept that we're talking about, and we're building up a series for every beginner. So if you're watching this for the very first time, make sure to subscribe, like, and share this video with your friends and family. And of course, we're just gonna jump right away into the example. Okay, family, I'm gonna try my level best to explain this concept to you as simple as possible, right? So I have two examples that I just brought up for each and every one of you, just to understand this concept. I have number one, I have a bearish trend. As you can see, I have a bearish trend, okay? And of course, number two, I do have a bullish market. Okay, so let's just draw the arrow right there just to make sure all the newbies also understand what I'm talking about. Now, when we're talking about the break of structure, so I'm going to start with the break of structure. We're talking about the validation of a trend. So what do I mean by that? Is that when the market is in a downtrend, it needs to give us, or rather imprint lower lows. So we have a lower low, we have lower highs. So a break of structure would be that when the market has given us a lower low right there, so I'll just take that first one, it gives us a lower low. The market will break that structure. So that lower low, it is a structure. Hence, we refer to it as a break of structure. And why is it a break of structure? Because it is a validation of a downtrend, to say since we broke structure, we are now forming the very actual pattern of a downtrend, which is another lower low, in order to form a new lower high. So if it's breaking structure or breaking lower lows, it's simply saying to us that it's confident enough that it's gonna be still going down, or to you as a trader, the market, it's communicating to you that it's still gonna be going down. So I'll place all the break of structure there. So we have the BOS right here, anything that the market breaks, okay? So it can be a full candle that breaks it. So any lower low that the market just breaks. So we have that lower low, the market broke it, right, in this example. And of course, I'm gonna be going straight into the very chart after I just laid out this foundation. Okay, so with the BOS, with multiple BOS, so it's not just one, as long as structure is still moving in a downtrend. In this case, we do have the BOS right there. Let me just clone this. Then you can see exactly what I'm talking about. So with multiple breaks of structure that the market will give us in order to validate that we're still in a downtrend. Let me just draw another one lastly. And we mark it. So there we go. So with multiple breaks of structure to validate that the market is still in a downtrend with lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. So when it breaks lower lows, it's simply validating to you and I that we're still going in a downtrend, because the very concept of trading is to want to sell high. So when the market breaks a structure, it's simply saying to us that it's still going down, but it's gonna, of course, repeat a pattern that's very much familiar to us as traders in terms of movement, where we know that since it gave us a lower low or it broke structure, we know that we can anticipate a lower high. And because of that lower high, that's where we want to enter as traders. We want to sell high. And of course, smart money concept is the very best way to find those lower highs in the market. But now there's another way, because smart money is all about mastering a pattern that institutions are trading within the market to trick retail traders, right? And of course, institutions, they have to take liquidity, or of course, they have to take liquidity and fill in imbalance. So that's the main things that I want to talk about. So when it comes to liquidity, liquidity is a point where it's quite obvious that retail traders are going to be selling at or buying at. For example, we have this equal lows right here. The best way is to have equal lows. And of course, since we have that equal low, when the market gets to break it, we will call that liquidity. Because why are we calling that liquidity? I will just explain it right now. Okay, so this equal lows, many of us, we know that we know a pattern called double top, right? And a double top, they will teach you to say you will sell right here when the market comes back to touch for the second time. Great, right? You will sell and you'll be anticipating that the market will go all the way down to create a new lower low, right? And what will happen is that the market will come back and stop you out. And then while it's stopping you out as sellers or coming to hit your stop loss, let me just put it right there. Okay, so let's say the stop loss is somewhere here. And so it takes those stop losses. And of course, once it's taken those stop losses, there are traders at the very same point that you're putting your stop loss, they're also putting their buy stops. So we have traders putting buy stops. And of course, what happens is that it takes that buy side liquidity, so it triggers them in and drops the market down. So what liquidity grabs are all about is to create a point to induce traders, to manipulate traders to sell and buy, so that that money that they're pumping in the markets is the same money that the institutions are using to grab or to move the market. Because the market is moved by the economy in terms of direction, but in terms of movement, there's a certain algorithm of force that's in charge of the movement. So let's say for DEX or for NASDAQ itself, right? Maybe according to the microeconomics of it, to say, well, NASDAQ will be going down fundamentally. According to Tesla and all of the companies, it shows that they will be losing value or depreciating in value. That will result into the market falling. And because of that, it will fall eventually. But the whole structure in terms of lower lows and lower highs, that's when now smart money is in charge of creating that to move the market in the direction anticipated fundamentally. I hope you understand me, right? I hope you understand me, family. I really, really do hope you understand me. So we do have those buy stops, sell stops be taken out, and the market, of course, triggers those buys, drops the market. Once it does that, of course, there will be levels right here, supply or demand. I will get to the next episode where I talk about that, where you either have an order block or you have anything that really gives you an entry signal to say that's when you can now sell, and what you're achieving the selling high, and you will see a lot of momentum kicking in. Once it kicks in, of course, you do have another break of structure. What is the market telling you? It's telling you that it's ready to create a new lower high, So what happens when the institutions do that? Many people will conclude that we have a break and retest right here. So they'll create a retailer sentiment again to say, because we know break and retest. I used to trade break and retest, by the way. We have, when the market breaks of structure, comes back to retest, a lot of people will be selling right there. Of course, what will happen, they will give you that profit, and you're anticipating that the market should go back all the way down. And sometimes you may hold a trade, maybe saying, well, it's going to come back to create a double top and sell maybe further down. And what really happens is that the market again comes out to stop the sellers out. Of course, there are people who are scalping, but many people want to hold the trade because of the very pattern that we know, that since it created a lower high, it needs to go all the way down. Well, it does not go all the way down. It comes back, stops you out. And of course, at the very point where it's stopping you out, there are buy stops that are being triggered. Once they're being triggered, of course, the market is going to a point where probably there's a supply right there that's being touched or mitigated, and they sell the market. Okay, so we have the break of structure being broken to indicate that we're still in a downtrend. We have the liquidity being taken so that they can move the market. That's the whole concept, guys. I just hope you understand. Woo! Guys, I am teaching it better than how you're subscribing right now. So if you are a first-time viewer, you need to subscribe. I'm telling you. Okay, now let's go to a bullish market, right? A bullish market, the very same thing now that we have higher highs in the market. So we have points where the market is giving us higher highs. There we go. And of course, we have high lows. See if I can just, draw all of them there. And of course, I can just grab this one. We have higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. And of course, the break of structure here would be us breaking higher highs in order to create higher lows, because we want to buy low so we can go up with the market. We're in a selling on the bearish market, we want to sell high. In here, we want to buy low. So we need to buy at lower highs. So what happens, or how the market will be telling us that it's still going higher when it breaks higher highs, which we can simply refer to as the break of structure. Okay, let me just move that. Take this one right here. So we have the BOS that's been broken now. As I said, we must be relevant in context with the trend. Okay, so we have the BOS there, it's broken. Once it's broken, we can definitely anticipate what new higher highs, which is what the market did. And of course, we want to buy at the higher low. So what happens is that we have other breaks of structure that I'm going to just be taking from here. So we have another higher low that's been broken. That's the very same way I taught the bearish market concept. Okay, we have another break of structure right here when the market breaks it. Okay, so you can mark all of them. So the reason why we mark our charts is so that you can understand what we're referring to. So if BOS, break of structure, higher highs have been broken to indicate that the market is still going higher. And of course, we can still have that higher high being broken. Okay. So what now really happens? We have BOS. So what happens again? It's number one, it's telling us that we're still in a bullish market. So when it breaks higher highs, it needs to come back to create lower lows. Now, as I said, in the institution, they will create a level where they want to take liquidity with retailer sentiment. And of course, that's what we have right here. We have that liquidity being taken so that they can come back and create their own lower high. Okay. Again, many of us would say, well, we're buying because we're seeing a double bottom. So we're buying because we're seeing a double bottom. So we have this lower high, but this lower high will be a liquidity for smart money to grab, because they know a lot of traders are anticipating this kind of trading. It's all over. Double tops and double bottoms are everywhere. But that's a retailer sentiment that they will take so much. So they will take this. So basically, they will induce you guys to take buys. So they say buy this market, and of course, it should go all the way up. And of course, once it goes all the way up, what happens? They'll tank it all the way down, hit your stop losses, as we're saying right here. So they'll hit all of those stop losses. Once they're hitting all of those stop losses, we have legends in the market, generals in the market, where they will put, of course, buy stops right there. Okay, they'll put buy stops thinking that structure is changing. And what happens when they put those sell stops, rather, sorry about that. They'll put sell stops here, they will trigger them in, and they'll rally the market up. So they've taken liquidity of sellers, they've taken liquidity of buyers on the very same point, and they push the market up. Are you guys getting me? And that's the very same thing again. With break of structure, we have new higher highs that the market creates. There we go. And of course, what happens? They will create a lower high. Okay? They will create another lower high right here. But now that lower high, of course, they will use it as a liquidity grab to make sure that they can still push the market higher. Okay, because the market can't just go higher from a place where it's even higher. It needs to come back and grab liquidity before it can go up. So as we have, let's conclude here, there's maybe a demand level that's in there, and they push the market up. That's exactly how the market works when it comes to break of structure and liquidity grabs. I just hope you understand, family. Of course, we do go in depth in this concept on how to know exactly when, or which supply and demand will the market be reacting to. What happens, what signs you need to look for. So we do go in depth in terms of trading this or trading trends. So definitely, if you want to further or take a step further into learning smart money concept, and also our personal strategy that I've developed over the last 6 years, you may be enrolling in our courses, completely affordable for each and everyone, family. And of course, if you did enjoy this, make sure that you subscribe if you're a first-time viewer, as well as oh, I almost forgot, family, I need to show you the chart example of this, so that we can really, solidify this concept. Okay, family, so I just want to show you this place right now. I just took this example that took place last week. And as you can see, we have a bearish market, break of structure right there. Now, as you can see, since we have a lower low, we have a lower high, we have a lower low. Now, many people will conclude from here on, we're still going lower. So many people would say, let's place our short position. Okay, let's place it. And of course, what would happen is that the market will of course trigger you in, induce you. But now, soon as you are so happy that you're in profit, they take that liquidity. So they take you out via that. And of course, as you can see, it kind of really took all of this liquidity here. In fact, we can also draw a trend line liquidity that was taken right here. So it gets even more advanced, unlike just equal lows. There's trend line liquidity that the market takes. A lot of people would say that because that's a retailer sentiment, right? We have lower highs. So they'll say, well, the first touch, the second touch, the first touch, the second touch, and of course they will say, well, this is the third touch, and what you should go ahead and now sell the market. Once they say that, the market now takes all of that liquidity that they were anticipating that it was going to be selling because they're in a downtrend, takes them, and of course triggers us smart money concept in that. So we can definitely see where the market got to react to, okay, all the way to this point. We can see where that sell came in right here. Beautiful, right? And the market, of course, you can just play it out. It dropped all the way with so much liquidity because it had already grabbed that liquidity.